welcome to another great video. We're talking OAS. We have lots of questions on OAS, specifically the clawback. This one here came from William. I hate paying tax. Who likes paying tax? Everyone hates paying tax. But in his case, he's saying, I hate paying tax. What is this clawback I hear of? How do I avoid it? So we're going to talk about both pieces. We're going to focus on what is the clawback, explaining that. But to do that, first we have to need a little bit of information on OAS.
Yeah, I mean, let's give you the basics on what the OAS is. Now, OAS is a pension that is based for seniors in Canada. Now, it is based on residency. It is not an income-oriented scenario.
We don't
or
pay
direct contribution. That's right. You have to have lived in Canada at least 10 years, be after the age of 18. And to get the max, you must have lived in Canada for 40 years after the age of 18.
Yeah.
It's funded by federal government revenue, so as opposed to CPP, which is not. This is government-oriented. And it starts at 65 or after. You cannot take it early. You can always delay it. And the payments are adjusted annually or quarterly for inflation that goes on going forward.
And that's key. They're adjusted for inflation. So most people do get the max, and that benefit does get little top-ups every quarter for inflation. The clawback, because this is really
that's the big one that we're looking at.
The question William was asking about is there's a threshold, and it's based on your income, individual income, not household income.
No. Each person.
Individual income above this threshold, they start taking some of that pension back. The threshold changes. It's not set in stone.
Year.
Every year it gets adjusted. Right now it's $90,977. That's
almost 91.
Yeah, that's according to the government website, canada.ca. And the threshold does increase. How they increase it is that October to December period, whatever threshold increase they've done there, because remember, OAS adjusted quarterly.
It's quarterly adjustments.
That'll be the one, so the most recent adjustment is the one they use for the taxes of that year. So the October to December 2024 quarter, that adjustment to the threshold is the one they'll use
2025.
For the 2024 tax return, which will file in 25. But the idea of the threshold here, every dollar above the threshold, they take 15 cents of your pension benefit away. It's like a 15% tax. No one likes paying tax, so you don't want to do that. 15%. Quick example of how this works is so they use government data, Kevin. They use your tax return.
Yes, they do.
And we'll go through the details.
Yeah, so for an example, specifically they use your net income before any of your adjustments. So it's line 23,400 on your tax return.
Yeah,
so
that's important.
Exactly. So taxes filed by the end of April. Normally it'll be adjusted in July. So if we take an example for 2024 for your return in 2025 of April, if your net income is say $100,000, if we take away the $90,977, that means you're over by $9,003.
Yeah.
So that $9,003 is where that tax is going to come in. So 15% of that is $1,350.45. Now that's over the course of the full year. If we divide that by 12, you're looking at a July 2025, your monthly OAS, because they do it every 6 months, starting in the year. In the July, you're going to be reduced by $112.54 every month from what your max was beforehand, because you've been over by roughly 10%.
Yeah, and that's the whole concept. They look at your tax return. So in our example here, you file your 2024 tax return in April of 25. They look at that, and then they look at that net income before adjustment, so that line 23,400.
That's the big one.
And then they'll make any appropriate adjustment in July.
That's right.
And then they do that every year. So every year it gets adjusted. How do you avoid the clawback? There's lots of strategies, but the reason we went through that example is all the strategies typically look at that threshold and how to get your individual income, not household, but individual income below that threshold. That's really what all these strategies are trying to get after.
That's right.
A couple of them, we'll go through these quickly here. You can look at the timing of capital gains. If you have a cottage, maybe you have a rental property, maybe you have stocks in a non-registered account, when you sell those or incur capital gains, could impact your income, so the timing of that needs to be carefully considered. RSPs and RIFs, of course, any withdrawals there are fully taxable, so you got to be cautious and strategic about how you take the money out.
When you take it out.
Exactly.
You got to also look at, if you're working part-time, if you're taking RIFs out, if you're taking anything else, if you've got part-time work included as well, that may increase your income, so watch what you're doing part-time for work. Of course, another big factor is income splitting.
It's a big one.
If you are a couple, you can split income. You don't want one person having all of it, the other one not having any. So you split that income. That can lower you both under that OAS. That's a big factor to deal with. And then, of course, there's always deferral.
Yeah, if you're saying, hey, I'm working part-time, my OAS is going to get clawed back, you can defer the OAS. You don't have to take it right away. And same thing with your CPP. You can defer your CPP so you have lower income, avoiding the clawback. We have a video that goes through these strategies in detail. If you want more on how to avoid OAS, we'll link to that video here. On with the explanation, because there are some strategies that don't work, and we want to explain why that is the case and provide a couple of nuances here. First, an important consideration. This is done annually. This is an annual assessment. It's not permanent. It's not as if you go over the threshold once and your OAS is permanently clawed back. It's assessed every year. So if you had a spike in income, let's say you sold a cottage and you had a capital gain, so your income jumps because you sold that cottage. Well, maybe for 1 year,
you're not going to get anything.
Yeah, your OAS could be clawed back, but then the following year, assuming your income goes back down, it's restored, and you get all of your OAS back. So that's important. It's assessed annually.
That's the biggest first one. And again, I mean, if you have questions on this one or any of the other things we've done for the explanation before we get to the avoidance, you know, you can always go to our website. Go to chatwithclintonkevin.com. We're more than happy to answer questions on any of these aspects for OAS or on any of the webinars or anything else we've put on there. The stuff will come right directly to Clinton and I, and we'll be able to get questions back to you really quick. But that's sort of a quick scenario for there. One of them, as you mentioned, though, is the nuances of clawbacks and how you can calculate for tax strategies.
400
Exactly. That is before these deductions. So, you know, sometimes, depending on what you want to deal with, it may not work out as well if you're dealing with capital gains, if you're dealing with any of the other deductions that you've got going forward.
Exactly. So sometimes we hear this, folks say, okay, my income's a little high, but I made a charitable contribution. That should bring
Take it away.
Yeah, it'll take it away. My OAS will be fine. Not how this works. No. Charitable contributions are great. It helps the charity, which is important. Also, you get some tax savings.
Helps you in the long run.
Any tax credit, whether it's charitable contribution or not, it comes in by reducing your tax payable, which is later in the tax return.
After 23,400.
That's the key point. So they look at that line, they'll reduce your OAS, and then you might still get the tax savings as a result of it, but you will have lower OAS because it won't actually impact the OAS clawback. So that's important to note. Another has to do with capital losses.
That's exactly it. Now, similar to the TFSA, the government does include capital gains. So if you've sold the home or you've sold the cottage, there you go. You can add that on. But
it's added to your income.
It's added to your income automatically. But if you have losses that you want to calculate, again, that comes after 23,400. So your capital losses don't count. So even though you may have sold something, gotten a large profit off it, you've counteracted it with a whole bunch of stuff that didn't make any money, that doesn't apply. The government's going to say the gain does, the losses don't. Yeah. You're going to have to worry about your OAS being clawed back, possibly.
And again, it's how they use the tax return to determine the OAS clawback here. That's what we're trying to explain is the nuances of the calculation. They use that 23,400. Again, this is from taxtips.com. That's where we're getting the data. Important to mention the source. So if you have that capital gain will increase the net income before adjustments. So that line 23,400 gets bumped up. Capital loss comes in later. So you'll save the tax, but it won't help with the OAS clawback. So again, we mentioned some strategies earlier that are effective. These strategies, unfortunately, because of the nuanced calculation, are not effective. So you have to keep that in mind. And a concluding point here, which is important, lots of details explaining the clawback. How many people does this actually affect?
Actually, very few. You're looking at about 8.3% of the population this affects.
OAS recipients,
OAS recipients in the population that it affects. So you're right. I mean, roughly less than 10% of people are actually affected by any of this. And that's not for the entire clawback. That's for any of the clawbacks. So if you're over by 1,000, you're part of that 8.3%. So it's anybody there. So as we see, it's not the majority of people out there, but those that do have cash that are concerned about it, these are things that you have to worry about going forward to make sure that A, you're not getting that clawback, and B, are there ways I can avoid it?
Yeah, and this is from a Globe and Mail article that's published in February 2024, and they said 8.3% of OAS recipients, people getting it, are impacted with the clawback, but like you said, that means 91.7% are not impacted. Important to note that if you are impacted, of course, no one likes to pay the tax, so you can keep all of what we just talked about in mind. And if you want more, we have a great webinar, so not just a video, but a full webinar on how to get the most from CPP and OAS in retirement. We cover lots of detail of both pensions there. Click on that guy. We'll see you again very soon.
Check it out.